Hey guys, it's me, Wooden Papa, and you are watching the channel with the best crypto tips, tricks, hacks, and information. Are you ready for today's video? Let's jump into it. Margin trading is as simple as this. You're trading with more funds than you actually have. In order to do this, you have to have collateral or funds that the exchange will hold in place. And what happens is by putting those funds into an exchange, you put them, or 100%, 10%, 50%, whatever you decide, up as collateral to borrow more than you actually have. By borrowing more than you actually have, you can use a leverage multiple, 1 times, 5 times, 10, 25. Some exchanges offer as high as 125 times leverage. Now, more is not better, while the returns are much greater when you use a higher leverage multiple. The risk is that much greater. Here's a scenario with a long position. The price of Bitcoin is $10,000. We're going to use 10 times leverage, and our margin will be $1,000. When the price increases by 5%, our profit increases by 50%. It increases by 50% because the price change is 5% on the market, but because we're using 10 times leverage, we're actually getting 50% profit. As the price continues to move up, so do our profits grow exponentially. However, there is a reverse effect. If the price falls 5%, that means that we lose 50% of our margin, our position. If the price falls even further, we run the risk of being liquidated. Liquidation is what happens when the market moves against your trade, so far so that the loss is the same amount as your margin. And in that case, you lose your position. This is what makes trading with leverage so risky, much more riskier than spot trading. And if you don't really understand what spot trading is, you can watch that video here. It'll pop up, and please watch that video to get a better understanding of what spot trading is. One other interesting thing that leverage trading can do that spot trading can't is shorting. Shorting is when you can sell at a high price and buy back what you've sold at a lower price. That distance in price becomes a profit. Let me show you a scenario. Let's say that your entry price is $10,000. You're using 10 times leverage, so your margin is, again, $1,000. If the price moves down 5%, you make 50% of your margin, which is $500. Moves down 10%, that's 100%, and it grows exponentially as the price moves down. If the trade moves against you and goes up 5%, you have lost 50% of your margin. Similar to the long situation, in a short, if the price moves up too far and your margin equals your loss, then you are liquidated. If you're just starting out and experimenting with leverage trading, there's no reason to expose your whole account, and there's no reason to go greater than even 2 times leverage. Use a small amount of funds as you are learning. I hope this video was helpful and informative to you out there that are learning how to trade with leverage. Be safe, trade smart, like, subscribe, and come back again for another video.